There will never be another investor like Warren Buffett.
Warren Buffett.
Warren Buffett.
Warren Buffett.
Legendary investor, philosopher, and CEO of Berkshire Hathaway, Warren Buffett.
He bought his first stock at just 11. He retired at 95. He's worth $150 billion today. He did it by buying pieces of other people's businesses. No company, no invention, no product. To understand why nobody can ever repeat this, you have to see how it actually happened. That story begins in Omaha, Nebraska, 1 year after the Great Depression crashed the American economy. Warren Buffett was born there in August 1930. His father, Howard, had just lost his job at a local bank. But instead of looking for another job, Howard used his last savings to open a small firm selling stocks and bonds. It barely kept the family afloat. Young Warren was a shy and quiet kid who spent most of his time alone, lost in the books from his father's library. And right there in that library, he found a book that fascinated him more than anything else. 1,000 Ways to Make $1,000. At just 6 years old, Warren bought 6 packs of Coca-Cola from his grandfather's grocery store and resold them door to door for a 5-cent profit each. Within a year, he was already expanding into magazines, chewing gum, and literally anything he could turn a profit on. But selling drinks wasn't enough. At 11, he took every dollar he had saved and bought his very first stock. 3 shares of Citi's Service Preferred at $38.25 each. But the share price plunged immediately, and he panicked. Heart racing, he waited, desperate for it to climb back to $40. And when it did, he sold it for a tiny profit, only to watch it skyrocket to $200 soon after. That mistake burned deep, and it taught him the rule that would one day make him a billionaire. Never sell a good investment too early. From there, Buffett went into overdrive. Within the next few years, he stacked 2 paper routes and built a small pinball machine business in local barbershops. By the time he was 15, Buffett used his side hustle cash to buy a 40-acre farm in Nebraska. But that's when things started to get difficult. After graduating from the University of Nebraska, Buffett applied to Harvard Business School. He took a train to Chicago for the interview, which lasted just 10 minutes, and they told him to forget it. About that interview, Buffett later said, "I was 19, I looked about 12, and I acted about 8. That rejection changed everything." Because while flipping through a catalog for Columbia Business School, he saw 2 names that changed his life: Benjamin Graham and David Dodd, the 2 professors who had written the most important investing books he'd ever read. He applied at the last minute and luckily got in. Benjamin Graham became his mentor. Buffett later described it as learning baseball from a fellow who was batting .400. Graham's philosophy was simple: the stock market is irrational. Prices swing wildly based on fear and greed. Your job as an investor is to buy when the price is far below what a company is actually worth, and then wait. Buffett absorbed everything, but he had a problem that almost derailed his career before it started. He was terrified of people. So nervous around strangers that he would sometimes throw up. This fear led him to sign up for a Dale Carnegie public speaking course. He later called that course the best investment I ever made. The diploma from it is the only one hanging in his office. After this course, Graham eventually hired Buffett at his firm in New York, where Buffett mastered the art of reading balance sheets and spotting undervalued companies. In 1956, Graham retired and closed the firm. Buffett went home to Omaha with his savings having grown from $9,800 to $174,000. He was 25 and already ready to do this on his own. Back in Omaha, Buffett launched an investment partnership from his bedroom with $105,000 gathered from his family and friends. He didn't charge a management fee. He only got paid if his investors made a profit, and he even agreed to pay for a portion of the losses out of his own pocket. For over a decade, he still didn't have a single losing year. He was returning 31.6% annually while the rest of the market was struggling to hit 9%. But then, Buffett did the unthinkable. He shut the whole thing down, feeling the market was becoming too greedy and overheated. He just did not want to gamble with other people's money. So at age 39, he walked away with $25 million and a reputation for being the most disciplined man in finance. He could have just stopped there. Instead, Buffett still owned shares in a failing textile company called Berkshire Hathaway. And the story of how he got those shares is one of the strangest in business history you will ever hear. Buffett had been buying the stock as a cheap investment since the early 1960s. In 1964, the company's owner, Seabury Stanton, offered to buy Buffett's shares back at $11.50. Buffett agreed. But when the paperwork arrived, the offer said $11.37.50, 12.5 cents less than they shook on. Buffett didn't sell. He got angry, and he decided to buy the entire company instead. He later called buying Berkshire Hathaway the biggest investment mistake I ever made, estimating the emotional decision cost him $200 billion in lost returns over the following decades. But instead of letting the dying textile company collapse, he turned it into a holding company for every investment he'd ever make going forward. And that vehicle, born from a 12-cent grudge, would become one of the most valuable companies in the world. Around this time, Buffett's good friend Charlie Munger pushed him to change the way he thought about investing. Munger told him, "Stop buying mediocre companies at low prices. Start buying great companies at fair prices." That shift changed Buffett's thinking. He started looking for companies with what he called an economic moat, a competitive advantage so strong that rivals couldn't touch them. Think Coca-Cola. Everybody on Earth knows the brand. A new soda company can't compete with 130 years of that kind of recognition. That's a moat. Using this new approach, Buffett loaded Berkshire Hathaway with stakes in companies like American Express, The Washington Post, and eventually Coca-Cola, buying $1.3 billion worth of Coca-Cola shares in 1988. He never sold a single one, but even that wasn't his real secret. The real secret was insurance. Buffett realized that insurance companies collect billions in premiums up front, and most of that money sits around waiting to pay future claims. He could use that cash to invest. So starting in 1967, he bought insurance companies one after another, including Geico. The premiums from those companies gave him billions of dollars of free capital to invest with. It was like having an unlimited credit line that paid for itself. Berkshire's stock went from $19 in 1965 to over $290 by the late 1970s. By 1990, it was trading above $7,000 a share, and Buffett's personal net worth crossed $1 billion for the very first time. Then the dot-com bubble happened, and it almost destroyed his reputation. By 1999, the internet was making everyone rich overnight. Tech stocks were skyrocketing. The Nasdaq was up 145% in less than 2 years. Investors were pouring money into companies that had no profit, no product, and sometimes no employees. Buffett refused to buy a single one. He said he didn't understand the business models, so he wouldn't touch them. People called him outdated, finished, too old for the modern market. Berkshire's stock dropped 44% while everything else soared. Barron's magazine ran a cover story asking, "What's wrong, Warren?" Then the bubble popped. Between 2000 and 2002, the Nasdaq crashed 77%. The S&P 500 fell 49%. Trillions of dollars were wiped out. And Berkshire Hathaway? It gained 80%. Everyone who called him washed up had lost half their money. Buffett lost nothing, because he never bought what he didn't understand. And when the 2008 financial crisis hit and the entire banking system was on the edge of collapse, Buffett didn't panic. He invested $5 billion in Goldman Sachs on his own terms, a 10% annual dividend, plus the right to buy even more stock at a discount. By the time the deal was done, he had made $3.1 billion in profit. While the rest of the world was terrified, Buffett was shopping. So why will there never ever be another investor like Warren Buffett? A lot of people assume it's because he's a genius. But the real reason is something that nobody can copy, no matter how intelligent they are. Let's start with the people who tried to beat the market using the opposite of Buffett's approach. In 1994, two economists, Myron Scholes and Robert Merton, founded a hedge fund called Long-Term Capital Management. They leveraged every $25 to 1, convinced their math had cracked the market. In December 1997, they flew to Stockholm and collected Nobel Prizes. 9 months later, their fund was bankrupt. They lost $4.6 billion in 5 weeks, and the Federal Reserve had to organize a bailout to stop a global financial meltdown. Decades later, investor Bill Hwang used hidden debt to turn $10 billion into over $50 billion. In March 2021, one bet went sideways. He lost $20 billion in 48 hours, one of the fastest wealth destructions in history. In 2024, he was convicted of fraud. These men were geniuses, but they were destroyed by two things Buffett never touches: massive debt and short-term thinking. He sat through crashes, recessions, and bubbles. He collected his dividends and let compound interest do the work. Warren never built a product, never launched an app, never filed a patent. He only bought companies that other people built, held them, and waited. And yet, he still ended up standing right next to Musk, Bezos, and Zuckerberg on the same list, worth $150 billion, with $60 billion already given away to charity. But the real reason there will never be another Warren Buffett is this: 99% of Buffett's wealth was built after age 56. He didn't become a billionaire until he was 56 years old. If he had retired at 65, like most people, he'd have been worth maybe 3 or 4 billion. Impressive, but you wouldn't know his name. The reason he became the greatest investor of all time is that he started at 11 and never stopped until he was 95. You can learn his strategy, you can read his books, you can even copy his exact stock picks. But you cannot copy 84 years of such an investment career, and that's why there will never, ever be another investor like Warren Buffett. Thanks for watching.